According to the investing wizards, the key to surviving a bearish market is to continue investing. Wait, but the S&P 500 was down 19.4% in the last year. The almighty bond market down over 13%, and the Nasdaq was down a whopping 33%. Although this may sound crazy, I kinda agree with the all-knowing wizards. Let me tell you why. A recession is defined as a period of economic decline during which trade and economic activity decrease. It is generally identified by the decline in GDP for 2 consecutive quarters. Be sure to like and subscribe in exchange of a sock joke by the famous ChatGPT. There is blood on Wall Street, and even safe haven investments like the bond market felt pressures of the inflation caused by the printing of money during the super flu lockdown. While recessions can be seen as providing a necessary reset in the market, they also result in tough economic conditions for the average individual and business. I had previously uploaded a video of ways you can generate some extra money during these tough times, but something that is equally as important as making money is keeping and hopefully growing the money you made. Today, we will discuss some of the best investment ideas in bearish markets with the help of history and some legendary investors. Also, we will be looking at an investment with a 99% chance of being profitable, so you definitely don't want to miss out on that. One of the worst mistakes you could possibly make as an investor in the stock market is panic selling during a bear market. Buying overpriced hype stocks is probably worse, but that's a topic for another video. This is why you don't want to sell during market contractions. Notice how over time, the market always goes up. Why would it stop now? To expand on this further, we have to look at the economic cycle, aka the business cycle. It is defined as the natural fluctuation of the economy through phases of growth and contractions. Keyword, natural. And here is legendary Peter Lynch.
What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks.
Now, let's put some numbers to this idea, shall we? According to Putnam Investments, if you missed the best 10 days in the stock market, your returns over 15 years ending December 2021 is 5% lower on an annual basis. It gets even worse if you happen to miss more days. And the wild thing is that these days tend to occur during downturns in the market. So, be prepared to face downturns because they're part of the game. But I'm going to show you cheat codes to this game. Only because I like you and you've subscribed to the channel, right? This, along with numerous research papers, support the notion that time in the market beats timing the market. Research done by Robert Shiller shows just how much of a difference time makes to investments. From the chart, it's clear to see that when you're invested for less than a year, you have about a 30% chance of losing money, compared to the 0.1% chance of losing money when your investment time frame is 20 years and longer. It's literally a no-brainer. And that, my friend, is the cheat code: long-term investing. However, there's no point to investing in the wrong asset for 20 years. So naturally, you may be wondering what the right investments are. Do you go with individual stocks and commodities or ETFs? To answer you, here's a famous bet made by Warren Buffett, in which he bet that 5 undisclosed hedge funds would fail to beat the S&P 500 over a period of 10 years when factoring in their fees and costs. And here are the results. With none of the hedge funds coming close to the S&P 500's returns, I mean, if hedge funds with people that went to Ivy League schools can't beat market returns for you, you're probably better off sticking with the index funds. Look, as boring as it sounds, the safest bet for the average investor is to dollar cost average into ETFs. But we're human beings. We didn't put men on the moon because it was the safe thing to do. We did it because it gets the blood pumping. Among other things, of course. Although ETFs are safe, if you completely ignore investing in individual stocks, you're potentially missing out on life-changing gains. Losses too. And some people argue that you could pick 20 to 30 stocks for yourself and that would essentially be your own ETF. But stock picking is an art that very few have mastered, and so we will briefly study one of the greatest artists, Mr. Buffett, and his methods of identifying businesses to invest in. Number one is that you have to understand the business and not just the stock.
A stock is part of a business. I mean, you can't think of a stock as something different. You value a business and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol.
Generally, you should look for businesses with strong financials and a history of consistent earnings, one that is still growing and preferably has a sustainable competitive advantage, or moat. It should definitely be a company you plan on holding for the long term, and most importantly, it should be trading at a discount to its intrinsic value. Determining the intrinsic value of a business, however, is the most difficult part of the process. Now, I've been waffling on about investing in the stock market, but there are other investments that could potentially yield higher returns for you in the long run, like investing in your earning potential. Here's the man himself.
And the best investment of all, I mean, if you're the leading brain surgeon in town or the leading lawyer in town or the whatever it may be, you don't have to keep re-educating yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, and you don't have to keep reinvesting. And you retain your earning power in current dollars.
You could increase your earning potential by trying things like entrepreneurship or networking with people in your industry for career advancement. You could also work on your personal brand, whether it be online presence, publishing articles, or participating in work-related conferences. This is something that is quite common in this day and age, especially with people working on their online presence. It makes sense though, because it is much easier to monetize a business idea or venture when you've already built a following. Finally, let's take a look at how asset classes have performed in previous recessions. A study was conducted by Liz Aldrich, where they looked at the performance of 12 different asset classes over the last 3 market downturns. What they found was a little surprising, with the top performing asset classes being agricultural commodities and fine art, returning an average of 7%. That may not sound like a lot, but when you consider that the S&P 500 returned an average of -17, then it's definitely a win. Other assets that generated positive returns include the almighty gold, farmland, wine, and residential real estate, which seems to be heading towards a rough patch right now. On the other end of the spectrum, we find Bitcoin with average returns of close to -40. History cannot be ignored, but by no means does past performance predict future returns. And remember, this is not financial advice,